Hey traders, Raghee here. And in this update, we're going to talk about the scale of today's sell-off by taking a look at historical volatility and probably the best scene in a movie. Maybe many of you have seen this, but if you haven't, head on over to YouTube and search within YouTube, Margin Call Peter Sullivan. You can see the title of the video down here, all right? Now, this is a neat little scene. It runs about, as you can see here, about 8.5 minutes long. It's a neat little scene where this guy, Peter Sullivan, explains to the office after crunching some numbers. You can see his horrified face there, crunching some numbers, realizing that the algorithms that this particular company had on the mortgage-backed securities had gone beyond the VAR, the typical volatility range. And this is when this scene right here, about halfway through the videos, when he explains to his higher ups, hey, this is broken, right? Now, I bring this scene up because understanding the volatility of the market is important. And whenever the markets are quote unquote broken, it's not because they're heading lower. It's not because they're heading parabolically higher. It's because the norm that we have factored in, whether that be what I use, which are price movement ranges, or if you use average true range, or if you're using Fibonacci retracements of 382 to 50%, because that's what the markets have been doing, whatever your ruler for normal is no longer measuring the market properly. So that's when the panic usually sets in into the market. So what I use is historical price movement ranges. And what these are, if you've never seen me use these before, is a 6-month look back and a 68% probability of what a symbol does is the QQQ on a particular day of week, or we can even get as granular as the hour of day. All right, we can even do that. And what this is going to allow us to do is put a measuring stick of normal against the market versus what it's done for the past 6 months. And this is a tremendous edge we have as traders to know where panic levels are and where they aren't. So I'm going to contrast two markets here. And I prefer to look at the NASDAQ futures even when I'm trading tech stocks and the QQQ. So we'll use the NAS and we'll do this process. And it's very cool and it's something that's repeatable and it will help you. What's a typical NASDAQ movement? NASDAQ futures. So this is the NQ contract. What's typical movement for the NQ? Well, on a Tuesday, you can see it's actually one of the lower and more narrow ranges. But on average, throughout the entire week, let's call it 250 to 300 on average, with the upper end being almost 400. So we'll keep the numbers round and whole. 250 to 300 normal, 400. Now, this is not directional. This is just the high to low range. It doesn't matter if the market sold off all day, just what was the high to low range in the number of points, okay? So now let's jump on over to the NASDAQ futures and look at what today's range was. Now, I'm not going to include any gaps. I'm just going to look at the high to low range that we're dealing with. And on Thinkorswim, you've got this nice little range calculator right there. So I'm going to put my cursor over today's candle and you'll see there the range today was 214.5 points. 214. Well, let's jump back on over to the historical volatility. Was today a panic day? Hardly. So if we look at that measurement, that measuring stick of normal, was today a day where shares were just being dumped? Not really. The reason today felt the way that it did, and I get it, gang. You know, when I look at my overall book of longs, they were down today. But here's the day. Here's 9:30 to 4 o'clock. All right, here's 9:30 to 4. What did this market do? It established the highs within the first 22 minutes after the bell and then never looked back. So the highs were put in during the clearing and then we melted down. I don't think this is an easy short, but in the premium video, I'll talk to you all about different VWAPs that we can use to get a better idea of these thresholds of when there's not a guarantee or certainty, but a probability of markets moving lower. I use 2 specific anchored VWAPs to do it, and we'll walk through that in the premium video just to get an idea. Hey, Rog, Could there be some selling? Do I need to be aware that maybe the markets could slip lower? I'll show you what that looks like. And it actually was visible in the NASDAQ and in the Russell today, by the way. All right, so there's the NAS. Panic selling? No, I don't really think it was, but it wasn't exhaustive either. So that means if the market wakes up in another bad mood, this could be potentially more weakness. So let's just keep that in mind. I'm not making this a bullish conversation or a bearish conversation, just trying to explain what we saw. So same thing here on the Russell. Now the Russell's a little bit different. The Russell 2, it put in its highs right during the clearing and then never looked back. But was the Russell tricky today? What's today's range on the Russell? Let's open this chart up. Today's range on the Russell was 71 points. 71. Well, was today kind of a panic day in the Russell? Well, let's go take a look at the RTY. So this is where you might say, okay, NAS really wasn't panicked, but was there a significant sell-off in the Russell? Well, typical price movement range, as you can see here on a Tuesday, upper end is 60, and we were printing up here at 71. So yes, this was a more significant sell-off. This also means that if you're looking for an opportunity to buy on the Russell and we exceed 60 points on the session, you probably want to wait for a pause candle, an inside day, or a minor low before you do anything. All right, if you're looking at the KRE regional banks, things like that, be a little bit more cautious. The Russell selling, actually, interestingly enough, is a little bit more inviting to buy, potentially, because it was exhaustive. It did extend past what it normally does. So there's sometimes an opportunity to look for buys once we get a little bit exaggerated in the move. But again, the challenge is, how do we know the market has done something beyond normal? Is this normal? And I hope that by looking at this data, you can see that there is a way to understand this, and there's a way that you can calculate and start to figure out when everybody else might be potentially panicking. You can say, okay, where are we within normal risk or normal price movement? And what is my risk then in this situation? All right, hope that helped. A little something different, but it's something we talk about a lot in the futures room when we're trying to place stops, when we're using targets. Think about this. When you've got information like this, placing targets, placing stops, understanding volatility is very different, because now we're looking at it historically. Check out that video from Margin Call. It's actually quite good. The movie's pretty darn good too, and I'll see you in the next update.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency. It's one of the things that won me